At 7:42 a.m., October 11th, 1930, the Dow opened with a contradiction no one could explain. Global trade had collapsed 67%, yet newspapers still insisted the recovery had begun. That lie detonated the first fracture. Because behind the optimism, a metric flashed red. The international debt web created after World War I had reached 310% of combined Allied GDP, a level worse than 1929 and far beyond the thresholds that crushed markets in 2008. But the real shock was this. Germany owed 132 billion gold marks. Britain owed the U.S. France owed Britain, and every payment depended on Germany, whose economy had already flatlined. The system was mathematically impossible. Then came the present-day mirror. 1930 margin debt surged 22% in a single quarter, surpassing early crash velocity. Charts turned red. Nations panicked. Stability was an illusion. History was repeating in real time. This collapse was mathematical. The numbers were worse than 1929. On the surface, the 1920s looked invincible. Rising wages, booming factories, middle-class families bought their first cars. Department stores expanded across American cities. Radio sales exploded. Yet beneath that optimism sat the most fragile financial architecture in modern history. Nations celebrated prosperity while the entire system depended on Germany making impossible reparations payments that were already falling behind schedule. The public didn't know it, but Germany's treasury did. Reparations were never payable. Not partially, not eventually, never. When the Dawes Plan launched in 1924, it temporarily softened the pain. Markets rallied. Newspapers celebrated a new economic order. Foreign investment poured into German industrial projects. Berlin became a cultural capital rivaling Paris. But the real numbers exposed the truth. Germany's required payments exceeded 3% of GDP annually, while its export capacity fell 17% below pre-war levels due to territorial losses and industrial restrictions imposed at Versailles. This was a mathematical impossibility, sharpened by a global environment already cracking. The numbers were worse than 1929. The U.S. Federal Reserve warned in a 1926 internal memo, reparations are dependent on foreign borrowing. This cannot be sustained indefinitely. But the warning was buried. The loans kept flowing. Investors kept buying German municipal bonds and corporate securities. Governments kept pretending the circular debt machine could run forever. By 1927, Germany owed $2.5 billion to American banks, money borrowed only to pay other nations, who then used those funds to pay America. This was beyond 2008 thresholds of recursive debt, where mortgage-backed securities were sliced and repackaged until no one understood the underlying exposure. The difference was scale. An entire industrial nation, not just housing markets, was leveraged into impossibility. This wasn't speculation. It was mathematics. The debt system could not survive a slowdown, let alone a global recession. The mathematics made the outcome unavoidable. By 1928, the world appeared calm. Stocks at record highs, exports stable, currencies steady. American investors poured money into foreign bonds. European governments balanced budgets with reparation inflows. The League of Nations published optimistic growth forecasts. But hidden inside the balance sheets of major banks was the real danger. Interlocked sovereign debts tied to a single failing debtor, Germany. This was the weak spot every documentary exposes, the point where a system looks strongest yet is seconds from fracture. Then the 1929 U.S. market bubble hit maximum insanity. Price-to-earnings multiples exceeded 32, surpassing modern dot-com levels when tech stocks traded at 100 times earnings with no profits. Insider selling accelerated 160% in 6 months as corporate executives dumped shares while publicly promoting unlimited prosperity. Margin debt soared beyond $8.5 billion, the highest in American history at the time, with ordinary investors borrowing 90% of stock purchase prices. Banks were leveraged deeper than they admitted, holding portfolios of questionable foreign bonds marked at face value despite default risks. History was repeating in real time. When the crash hit in October 1929, Germany's financing evaporated overnight. Wall Street losses exceeded $30 billion in weeks. Credit markets froze. Suddenly, A nation responsible for keeping the entire Allied financial system afloat had no access to new credit. Without new loans, reparations collapsed. Without reparations, Britain and France couldn't pay the US. A global chain reaction ignited. The system was already cracking. The world financial system was a single point of failure: Germany's liquidity. Once that point collapsed, every dependent nation followed. The pattern matched every pre-collapse period. The crisis detonated the moment American credit stopped. When Wall Street collapsed in October 1929, U.S. lenders froze new foreign loans immediately. Capital preservation became the only priority. The entire reparations system depended on continuous borrowing, not production, not exports, not growth, borrowing. This was the exact moment every previous bubble broke, and it hit harder than 1929 itself. By January 1930, German industrial production had fallen 27% as factories lost financing for raw materials and working capital. Unemployment surged past 3 million in a nation of 65 million, overwhelming welfare systems designed for peacetime levels. Tax revenues collapsed by over 20% as businesses failed and workers stopped earning. The Weimar government faced impossible choices: cut spending and deepen the depression, or borrow more and risk hyperinflation again. Those numbers were already worse than 1929, and the year had barely begun. A U.S. State Department note from early 1930 quietly admitted the fatal flaw. Without American lending, reparations default becomes unavoidable. Diplomats understood what markets refused to accept. The world had built its stability on an impossibility. A debtor nation that could only pay through perpetual borrowing was now cut off from credit markets. German banks began reporting liquidity stress. Depositors withdrew savings. Gold reserves drained. Bond yields spiked. The Reichsbank raised interest rates to defend the currency, which crushed domestic lending and accelerated business failures. This created a death spiral. Economic contraction reduced tax revenue, which increased deficits, which spooked creditors, which tightened credit further. The system was already cracking. The first domino had fallen. No loans, no reparations, no allied payments, no U.S. debt collection. The mathematics made the outcome unavoidable. When Germany's payments dried up, Britain and France panicked. Both had relied on incoming German gold to service their own enormous war debts to the United States, which exceeded $10 billion combined. These weren't optional payments. They were treaty obligations backed by gold reserves and export revenues. Without those inflows, their budgets imploded. Britain faced a shocking reality. Its government deficit surged beyond 7% of GDP, a level not seen since wartime mobilization. France wasn't far behind, running deficits that consumed revenues meant for infrastructure and social programs. Neither nation had the industrial growth to close the gap. Export markets were contracting globally. Unemployment was rising. Tax revenues were falling. Then the second crisis hit: capital flight. By mid-1931, Britain had lost over £200 million in gold reserves, an unprecedented hemorrhage that pushed the pound toward collapse. Investors knew the truth. Without reparations, Britain's debt structure was dead. They sold sterling and British government bonds, moving capital to perceived safe havens like U.S. dollars and Swiss francs. This triggered margin calls on British institutions holding leveraged positions. History was repeating in real time. A French Treasury report warned bluntly, default is inevitable if Germany cannot pay. But politicians pretended otherwise, issuing statements about temporary disruptions and imminent recovery. Financial markets ignored the propaganda. Spreads on French government bonds widened. Insurance costs for sovereign debt spiked. The credit default risk was being priced in real time. The market understood what governments denied. This was the moment the debt chain broke. What had functioned as a closed loop, Germany borrows, pays reparations, allies pay America, America lends to Germany, had become a broken circuit. Each nation now faced insolvency without the others performing, yet none could perform. This wasn't speculation. It was mathematics. European budgets depended on German reparations. Once those stopped, insolvency spread instantly. The pattern matched every pre-collapse period. While governments denied reality, banks were already dying. The most explosive example: Credit Unstold of Austria. the largest bank in Central Europe, collapsed in May 1931 under the weight of bad loans tied to German and Eastern European borrowers who couldn't repay in the contracting economy. The numbers were catastrophic. The bank's losses equaled 15% of Austria's GDP, an unthinkable figure that exceeded the bank's entire capital base. Half the nation's credit system froze as depositors rushed to withdraw funds, creating bank runs that spread to healthier institutions through contagion. International lenders refused rescue packages, fearing they would absorb losses from a bottomless pit of bad debt. This wasn't a local event. This was 1931's equivalent of the Lehman Brothers collapse. Only worse, because the interconnections ran deeper across more fragile economies. The collapse triggered panic across Europe. Banks in Hungary, Germany, Romania, and Poland failed within weeks as depositors lost confidence in the entire system. Savings evaporated. Businesses couldn't access credit for basic operations. Gold reserves evaporated as central banks tried to defend currency pegs. Stock markets plunged again, erasing what little recovery had occurred since 1929. The numbers were worse than 1929. Industrial production was now falling faster than during the initial crash. Then came the breaking point. Germany imposed a banking holiday in July 1931, closing banks to stop the hemorrhaging of deposits in gold. The world's fourth-largest economy had effectively declared insolvency. Foreign creditors held worthless paper. The Young Plan's payment schedule became fiction. International lending froze entirely as banks realized their exposure was unrecoverable. The system was already cracking. With major banks collapsing, governments losing revenue, and credit vanishing, the financial system entered a death spiral where each failure accelerated the next. The mathematics made the outcome unavoidable. With their finances imploding, nations turned outward. Every major power began fighting for markets, raw materials, and trade routes, exactly as they had before World War I, when economic competition hardened into military alliances and territorial disputes. Economic failure hardened into territorial desperation. Germany turned toward expansion because its economy had cratered beyond domestic repair. Domestic consumption collapsed with 30% unemployment. Exports couldn't compete with devalued currencies elsewhere. The only remaining path to solvency was acquiring resource-rich territories and captive markets. Japan pursued conquest in China after exports collapsed 50%, destroying the silk industry that employed millions and wiping out export revenues needed for debt service. The military seized Manchuria in 1931, establishing a puppet state to extract coal, iron, and agricultural products. Italy sought colonies to compensate for unemployment that hit 20% and threatened political stability, invading Ethiopia in 1935 despite League of Nations sanctions. History was repeating in real time. A 1931 British intelligence review warned, "Economic pressures are transforming into territorial pressures. This is the trajectory that precedes conflict." The pattern was unmistakable to analysts studying demographic stress, resource scarcity, and fiscal collapse. But the real danger was this. Every nation needed new wealth because the old debt structure was dead. The circular finance system had collapsed. Reparations were unpayable. War debts were uncollectible. Domestic economies couldn't generate sufficient revenue for recovery and debt service simultaneously. The only mathematical solution was external wealth acquisition, through trade dominance if possible, through force if necessary. War wasn't ideological, it was financial. Fascism, militarism, and nationalism were symptoms of economic collapse, not causes. The underlying driver was liquidity crisis and debt insolvency, creating political pressure for any solution, including conquest. This wasn't speculation. It was mathematics. Once the financial system broke, geopolitical aggression became the only remaining economic strategy. The pattern matched every pre-collapse period. The world pretended Germany might resume reparations someday. Diplomats held conferences. Economists published adjustment plans. Politicians gave speeches about international cooperation. But the truth was brutal. By 1932, Germany's real GDP had collapsed over 23% from 1929 levels. Unemployment exceeded 6 million, nearly half the industrial workforce, and exports had shattered into dust as global trade imploded. In financial terms, Germany was a corpse nations kept pretending was still breathing. The numbers were worse than 1929, The decline was steeper and showed no signs of stabilizing. This created a structural death loop. Germany couldn't pay reparations without economic output, but economic output required capital investment, which required foreign loans, which required credibility, which required making reparations payments. The logic was circular and broken at every point. Britain and France couldn't pay the U.S. without German reparations funding their budgets. The U.S. couldn't balance its budget without those debt payments, as federal revenue had dropped 46% and states were defaulting on bonds. Politicians refused to admit the system was dead, clinging to the legal fiction that obligations remained enforceable. The contradictions were violent. Newspapers reported stability as breadlines stretched for blocks. Bank records showed insolvency while governments issued optimistic forecasts. Politicians promised revival while debt tables showed obliteration. A U.S. Treasury analysis in 1932 stated coldly, "Collection depends on German solvency. Germany is insolvent." The arithmetic was inescapable. Debtor capacity had fallen below minimum payment thresholds and continued falling. This was exactly the condition every previous global collapse shared. The moment when mathematical reality could no longer be masked by political statements or accounting adjustments. The system was already cracking. The reparations system had crossed the mathematical point of no return. No debtor could pay, and no creditor could survive without payment. The pattern matched every pre-collapse period. Most documentaries ignore the key truth. The United States was not just a creditor. It was the global creditor, the origin point of loans that funded every allied government, rebuilt European infrastructure, and financed global trade. When that stream dried, Washington faced a nightmare. Federal revenue dropped 46% between 1930 and 1933, the steepest collapse in American history, exceeding even Civil War disruptions. Banks failed by the thousands. Over 9,000 institutions closed between 1930 and 1933, wiping out depositor savings and destroying credit creation. States defaulted on bonds as tax revenues evaporated. Arkansas stopped paying teachers. Cities cut police and fire services. The U.S. itself approached technical insolvency as debt service consumed growing portions of shrinking revenue. History was repeating in real time. This triggered a single unavoidable calculation inside America's financial and political elite. If Germany does not pay, the entire post-war U.S. financial architecture collapses. The Hoover administration fought desperately to maintain the illusion, proposing debt moratoriums and restructuring plans. Internal memos read like panic notes. Non-payment by Germany threatens the entire credit position of the United States. Treasury officials calculated that full default would trigger a cascade affecting municipal bonds, corporate debt, and international trade financing, a systemic breakdown. This wasn't about revenge against Germany. It wasn't about morality or justice. It wasn't about geopolitics or ideology. It was about collecting the money, the principal and interest that American institutions and bondholders expected and that government budgets required. Every compromise, debt reduction, extended payment schedules, interest rate cuts, reduced the mathematical recovery, and increased domestic fiscal pressure. And if diplomacy couldn't force payment, other tools would be considered. Economic isolation, trade sanctions, and eventually harder measures entered policy discussions. This wasn't speculation. It was mathematics. The U.S. realized it had staked its entire financial system on reparations that were never payable. This locked Washington into an escalating strategy that pushed the world closer to conflict. The mathematics made the outcome unavoidable. Economic desperation produces a predictable cascade. Every major collapse, 1929, 2008, the Asian crisis of 1997, the Latin American debt crises of the 1980s, follow this logic. When money fails, extremism fills the vacuum. Germany, bankrupted and humiliated, turned to political radicals promising recovery through force and national revival. The Nazi Party's vote share exploded from 2.6% in 1928 to 37.3% in July 1932 as economic conditions deteriorated. Japan pursued expansion after export implosion destroyed its economic model, with military factions seizing control of foreign policy. Italy turned to aggression after unemployment passed 20%, with Mussolini's regime pursuing imperial ambitions in Africa. Even democratic France shifted to authoritarian economic controls, establishing capital restrictions and state direction of industry. The numbers were worse than 1929. Unemployment, bank failures, and GDP contraction all exceeded initial crash levels and showed no recovery trajectory. This wasn't random. This wasn't cultural. It was structural. Collapsed tax bases, failed banks, and soaring joblessness created political physics that functioned like natural law. The causation was mechanical. Desperation led voters toward radical parties promising drastic solutions. Radical parties gain legitimacy and power through democratic or quasi-democratic processes. Those parties then pursued militarization as both an employment program and a foreign policy tool. Militarization transformed conflict into an economic strategy. Territorial acquisition became a balance sheet solution. The League of Nations tracked the shift with alarming clarity. A 1933 report stated, "Economic collapse has produced political extremism in every major nation." What no one noticed was the global synchrony. Every nation radicalizing at the same time, under the same debt pressures, driven by the same mathematical collapse. History was repeating in real time. The financial system's fracture didn't just bankrupt economies, it weaponized governments. This was the final weak point that turned a solvency crisis into a geopolitical explosion. The pattern matched every pre-collapse period. The collapse that pushed the world toward war did not begin with soldiers. It began with currency failure. When Britain abandoned the gold standard in September 1931, the financial world fractured instantly. The pound plunged 25% in weeks. Capital fled sterling-denominated assets. Exchange rates convulsed violently as speculators attacked currencies tied to gold. Nations retaliated with tariffs. The U.S. Smoot-Hawley tariff raised duties to historic highs. Other nations responded in kind. Capital controls that prevented money from leaving borders, and currency devaluations that tried to export unemployment to trading partners. This was the death signal. A synchronized global financial system had turned into a battlefield of competing currencies where every nation tried to beggar its neighbors. History was repeating in real time. The numbers were catastrophic. World trade collapsed 67% between 1929 and 1933, the steepest peacetime decline ever recorded, exceeding even the trade disruptions of World War I. Global industrial output fell 38%, destroying production capacity and employment across every major economy. Unemployment exceeded 30% in Germany, 25% in the United States, and 20% in Britain, figures that overwhelmed welfare systems and created political crisis. These numbers were worse than 1929, worse than 2008, worse than any recorded peacetime collapse in modern history. They represented a complete breakdown of the international economic order. A 1932 League of Nations report warned in chilling language, "The international economic system has ceased to function. The mechanisms that coordinated trade, investment, and payment across borders had failed. Once trust in currencies died, diplomacy died with it. Nations could negotiate when they could agree on the value of money or the enforceability of contracts. The system was already cracking. Currency collapse killed the last remaining stabilizer. Without stable money, nations had no mechanism to resolve the debt crisis peacefully. The mathematics made the outcome unavoidable. By 1933, nations were out of options. Budgets were broken beyond repair. Taxation couldn't fill the gap between revenue collapse and spending needs. Borrowing was impossible as credit markets remained frozen and investors demanded prohibitive interest rates that governments couldn't pay. Social unrest was exploding, strikes, protests, riots, as unemployed masses demanded action. This is the stage every major financial documentary shows, when liquidity failure turns into political aggression. Nations made a brutal economic calculation. If we cannot pay our debts, and our creditors cannot forgive them, we must acquire wealth by force. Germany's military spending rose 170% between 1933 and 1939, funded not by economic growth, which remained negative or stagnant, but by the liquidation of political opposition, confiscation of Jewish assets, and rearmament disguised as employment programs that created demand without producing exportable goods. Japan's invasion of Manchuria in 1931 and later full-scale invasion of China in 1937 was fueled by the collapse of silk exports, the nation's largest revenue source, which fell 65% and destroyed rural economies. Italy's expansion into Ethiopia in 1935 followed its banking crisis and credit freeze that left the government unable to finance domestic recovery. This wasn't speculation. It was mathematics. Then came the ultimate financial contradiction. U.S. creditors still expected Allied repayment. Their domestic political constituencies and bondholders demanded it. Allied governments could not repay unless Germany paid them. Their budgets had no other source for debt service. Germany could not pay unless it conquered new resources. Domestic capacity was exhausted. The numbers were worse than 1929. A British War Office memo admitted the truth. Economic collapse has created a climate in which rearmament is seen as financial necessity. Military spending became the only politically acceptable stimulus program. Analytical conclusion: militarization was not a choice. It was a macroeconomic survival strategy. The pattern matched every pre-collapse period. By the late 1930s, policymakers understood a brutal reality. There was no way to collect World War I debts without a complete restructuring of Europe's political map. Financial collapse had reached its final stage. Nations bankrupt, unable to generate revenue sufficient for debt service and domestic needs simultaneously. Banks insolvent, holding worthless paper from failed borrowers across multiple countries. Currencies unstable, with competitive devaluations destroying the basis for international contracts. Trade destroyed, down 67% from pre-crash levels with no recovery trajectory visible. Extremists in power across Germany, Italy, Japan, and increasingly influencing policy elsewhere. Militarization accelerating as governments spent on weapons rather than welfare, preparing for conflict they saw as economically inevitable. Every condition of global crisis was met. Only one domino remained. The debt reset itself. On September 1, 1939, Germany invaded Poland. Hours later, Britain and France declared war, honoring defense commitments but also recognizing the system was beyond diplomatic repair. Within days, financial markets collapsed again. Stocks plunged as investors priced in multi-year conflict and economic disruption. Government bonds surged as capital fled to perceived safety, despite the issuing governments entering war. Gold spiked to record levels as the ultimate store of value. International lending froze entirely as cross-border claims became unenforceable and credit risk unmeasurable. And behind the geopolitical headlines stood the cold financial truth. World War II functioned as the forced liquidation of the impossible World War I debt system. A catastrophic reset, executed by nations that could no longer pretend to be solvent and could no longer navigate the contradictions peacefully. History was repeating in real time. When the smoke cleared in 1945, all debts tied to the First World War were wiped out, restructured into irrelevance, or rendered moot by conquest and occupation. The old creditor-debtor relationships were destroyed. New institutions, the IMF, World Bank, Bretton Woods system, replaced the failed architecture. This wasn't speculation. It was mathematics. War resolved what finance could not. It destroyed the old system so a new one could be built. Every number, every debt chain, every economic failure pointed to this outcome. The mathematics made the outcome unavoidable. The collapse of the World War I debt system did not happen because leaders were incompetent or nations were irrational. It happened because the numbers made peaceful resolution mathematically impossible. Trade fell 67% between 1929 and 1933, destroying export revenue needed for debt service and creating unemployment that demanded government spending. Debts exceeded 300% of Allied GDP, levels that exceeded sustainable thresholds where economies could grow and service obligations simultaneously. Bank failures erased liquidity across every major financial center, making credit unavailable for recovery investment. Currencies collapsed through competitive devaluation, eliminating the stable money necessary for international agreements. Rearmament became economic necessity as governments faced the choice between military spending that created jobs and provided political benefits, or welfare spending that acknowledged defeat without offering a solution. These numbers were worse than 1929, and they shaped a trajectory no politician could escape, no matter how skilled at diplomacy or committed to peace. The system had crossed the point of no return, the moment where debt obligations exceeded any plausible payment capacity and creditors couldn't survive without collection. History did not risk repeating, it repeated precisely. Every metric confirmed the pattern. Every decision followed the math. Every collapse triggered the next in a cascade that was documented, warned about, and ultimately unavoidable. There was no alternative ending once the debt structure was established at Versailles. The requirement that Germany pay 132 billion gold marks while maintaining economic stability was always impossible. The circular lending system, where American banks loaned Germany money to pay reparations that funded Allied debt payments back to America, was always unsustainable. The moment credit froze in 1929, the collapse sequence initiated and could not be stopped. The debt structure made war inevitable. This was not ideology. This was not speculation. This was mathematics. So the next time someone tells you World War II started because of ideology or a madman's ambition, you'll know the truth. It started because of math. Because the debts from the First War made the Second War mathematically inevitable. The same patterns are visible today: record debt levels, circular lending systems, nations borrowing to pay interest on previous borrowing. The question isn't if the system will break. The question is when. If you want to understand how financial collapse turns into geopolitical crisis, subscribe to this channel. We break down the patterns most documentaries miss, the numbers that predict what's coming next. Hit that subscribe button, because understanding history isn't just about the past. It's about seeing the future before it happens.